Welcome to this Skill Builder at-a-glance tutorial on financial mathematics. At its core, financial mathematics is about applying mathematical tools to understand and predict financial decisions. It brings together probability, calculus, statistics and algebra to answer real-world questions. Applications for financial maths can be found in banking, insurance, investments, all the way to a household budget. This session will focus on three key concepts in financial maths: interest rates, annuities, and stochastic processes. So let's start with interest rates. Interest rates are most commonly found in two scenarios. First is the way it alters the amount you may owe on any debt, and second is the amount that you may earn on any savings. If interest rates are high, you can earn more on any savings, but may also have to pay more on any loans, such as a personal loan or mortgage. When a lender lends money, they will do so with interest. This means that you will not only have to pay back the amount borrowed, say £10,000, but also an additional percentage of that £10,000. Let's take an example. Person A wishes to borrow that £10,000. The lender is willing to lend it to them, this is known as the principal, at a fixed 4% interest rate over 24 months. The 4% here is set over one calendar year, and this is also known as the APR, or annual percentage rate. However, this doesn't mean that they simply pay an additional 4% of £10,000. Let's consider an example. If person A agrees to the loan, they will pay a set monthly payment consisting of the principal, a portion of that original £10,000, plus interest, calculated at a rate of 4% APR. As such, repayments often look like this graph here, with very little principal, the orange line, paid off at the start. As that principal is slowly whittled away, the interest of 4% is being applied to a smaller and smaller amount, meaning that more and more of that fixed monthly payment goes towards the principal. Where the example just given for interest rates was in borrowing a lump sum and paying it off in smaller quantities, an example of an annuity is where an individual pays a lump sum in order to receive a guaranteed income. For example, you could exchange £200,000 of savings before retirement into a regular, predictable income stream. Financial maths helps us to calculate the present and future value of these payments and is vital for both institutions and individuals for planning and budgeting. One example of this is the discount factor, which is used to calculate the present value of future cash flows in an annuity. But out there in the real world, the future is uncertain. In that loan example earlier, you'll notice that I defined that 4% interest rate as fixed. However, lenders can also lend at a variable rate of interest, which means that the interest rate moves dependent on interest rate changes in the wider market. Stochastic modelling helps lenders to predict the often unpredictable movement of financial assets, such as fluctuating interest rates or stock prices. This kind of modelling is essential in financial risk management and investment strategy. Stochastic modelling is especially critical for actuarial scientists in predicting the risk and reward in providing insurance policies to clients. This short video only scratches the surface when it comes to financial maths, but an understanding of some of the key mathematics behind compound interest, annuity payments, and stochasticity will set you in good stead on your financial maths journey. Thank you for watching. For further guidance on financial maths and many other academic skills topics, please do consider watching our longer Skill Builder videos on Moodle. For further academic skills resources or to book an appointment with an SAS advisor, please go to www.kent.ac.uk/SAS or email us at sas@kent.ac.uk. Thank you.